Hello, welcome back. So in this video we are taking a look at a little bit of a different thing, an asset management company called Sofina Societe. And this one, as you can see here, is a private equity and venture capital firm specializing in direct and fund of funds investments. Now, this was a request from one of our Discord members to take a look at this one, and I thought it would make for an interesting video. Now, what is private equity and venture capital is the first thing to talk about. When we're talking about private equity, normally speaking, like a stock that you are buying in the stock market is public equity, is actually available for the whole public basically to buy it. Private equity is all these firms that are not public, and so they still have equity. They still have people that are actually holding the company. It's just privately owned. Now, venture capital firms, you can think sort of about them sort of like if you have watched an episode of Shark Tank, for example. These people over there are venture capitalists. What they are aiming to do is basically acquire companies or get a large percentage of ownership for a company. And if they can actually help with transforming them to better companies, make more money, and basically yield returns in the future. Now, this company here primarily invests in a portfolio of companies that engages in digital transformation, consumer, retail, education, healthcare, energy services, e-commerce, a lot of stuff, as you'll see here. Now, these kinds of companies, or sort of like venture capitalists, really, that are backed by a company, they need to be really good at what they are doing, because owning this kind of investments here is very risky. I mean, the big percentage of these companies, these private firms, will actually even bankrupt. And so you have to be like super careful about what kind of investments you are making here. And this is almost some sort of a conglomerate here, pretty much buying all sorts of different investments and trying to make money out of this. Again, it's actually a company that requires a lot of expertise here in order to continue making money, and also very good networking as well. Okay, let's take a look at what they have been doing though in terms of their financials and whether it's an interesting opportunity to buy. Now, it's been down 50% from its 436 euros here. This is in euros. And of course, this is a Belgium company, by the way, so it's actually listed in Euronext. So, P ratio of 2.86 is actually rather low here. You will see it going down and down because of the stock price. And of course, this is very cool to see. So, the price to free cash flow ratio is negative right now. And that is something that we need to examine, see why this is happening. Outstanding shares about the same, pretty much what they used to be. Total liabilities free cash flow, this is negative free cash flow. And revenue growth that has been increasing, this is a very nice thing to see. Net income growth that has also been increasing, but free cash flow going down, and we will examine why. Now, total equity growth has been increasing as well. And you will see some other things about the company, like the debt to equity ratio is rather low here. There's some nice return on equity. But of course, the company has practically zero overhead here. This is why you're seeing massive margins here. But that doesn't necessarily mean that the company is a buy, of course. Now, the company is also paying a dividend here, a dividend yield of 1.4%. And the net income payout ratio is 9.4, but the free cash flow has been negative last year. If we take a look at the dividends here, you will see that it has gone down from what it used to be. Although this happened many years ago, and I'm assuming the company was paying much more and decided to actually maybe keep some of their money and stop paying that money in dividends. That's a lot of dividends paid here. And this went down significantly in the upcoming years. Okay, let's examine the financial statements to see some of the details of the company here. Okay, now the company has been increasing their revenues quite a lot here, it looks like. And if we go down, you will see that the net income has also been increasing very nicely. So it looks like they are doing well. It looks like they are getting more and more profit, which is nice to see, of course. And if we take a look at the balance sheet over here, we will notice that the total equity has been going up, which is also very important here. 6.8 billion to 13 almost, so more than doubling here. Or actually a little bit less than doubling, but still about the same as doubling. And what is interesting to see here is the cash flow statement, because remember the net income of the company has been climbing here, has been going higher and higher, so 2.9 billion over here. And you may be seeing some values missing here. This is obviously not a SEC report, this is a European report. So some of these values are going to be different, they're not the same in terms of reporting. So they may be reporting less items here, for example. But you will see that basically the cash from operating activities practically becomes zero here. So why is this happening? So if you take a look at the other non-cash items, you see that it's basically matching the net income here. So why is this happening really? So remember that this is an investment company, and obviously investment companies can be having increases in their portfolio without actually increasing their cash reserves, without actually making any extra cash inflows and outflows. So more than likely this kind of non-cash item is basically the increase in value that the company has enjoyed in terms of their investments, but it's not a cash expense or a cash inflow. And so it has to be excluded because, again, it's not about cash. And this is why you are looking at free cash flow being that low here and even negative. This may not be a concern at all. This actually may be a company that could actually be having negative free cash flow and still be fine as long as the net income increases. It's a little bit of an interesting case and a little bit of a more weird case here. And if we take a look at the stock evaluation tool over here, let's see what the company is potentially worth. But remember, while you're seeing negative free cash flow, when the calculation happens here, it's not taking into account the actual cash flow here. So you won't be affected by this one. The results would not be affected. They're going to be as if the company is not really basically claiming these non-cash expenses. And so, yeah, you have to bear that in mind because you may be looking at a free cash flow that's negative here, but it's still a good thing. In this specific case, it's a little bit of the odd one out, really. So we will notice here that the revenue of the company has been increasing and tremendously well. Of course, we cannot go that high. We have to be more reserved and more conservative here. So, as I'm recording this, there is noise coming around. Somebody's doing some work, I'm assuming some building work, as you can probably hear through the video. So I may have to be pausing every now and then and coming back. So we are going to go with something like, let's just say 12, 15 and 18. And in terms of the net income margins here, they're obviously super high for this company, very little overhead. So let's go 90, 92 and 94. Remember, you may be seeing tremendous growth here and tremendous net income margins, but you also need to remember that these companies have a lot of risk. And so the moment something goes wrong, they could go negative very quickly in terms of their revenue and net income. So bear that in mind. The fact that they are doing well today doesn't mean that they will be doing well tomorrow. Very, very important to think about. But so far they seem like they have been doing well, and if we could calculate with an annual return of 13% and a free cash flow margin of 80, 90 and 100, what are we, again, remember we are not really taking this into account because this will skew our results, again, because of the fact that operating cash flow is actually getting decreased massively because this is investment income, so it's not really cash flow. However, if we actually add here like minus values, we will get very, very distorted results. We don't want to do that. We actually want to go for something that accounts for the net income that the company generates. And so if we hit calculate here, we will be getting tremendously high values, as you can understand. And the reason why this is happening is because we are converting all this net income to free cash flow, which is not the case. Remember, this is a company that is having investments. It is investing actively. And so it's going to be using its free cash flow and not returning it to shareholders. And the thing is, it's not returning it to shareholders for the most part as dividend as well, because the dividend is very low. They basically keep expanding. And even if you notice the fact that this may look insanely undervalued, again, you have to remember that this has a lot of risk, and it's basically a conglomerate of investments. It almost acts like a hedge fund, and so it's not really your normal business. It's a little bit of a different thing, and as I said, things can go wrong very quickly. And even though it looks great in terms of what they are doing and in terms of the stock price being potentially low for what it is, you probably have to be a little bit cautious about this one. Now, is it an interesting buy here? I think it is. It's down a lot. It's making good net income here, and pretty much the investments that they are making, they seem to be doing well. I mean, the numbers that they are generating are fine. And again, the price to free cash flow is negative. We talked about why this is happening. It's a non-cash item, how this is deducted in a cash flow statement. And so this doesn't scare me really. But and this is why this free cash flow growth is going in the negative. But again, it is a little bit risky holding this kind of position, this kind of company. Now, if you are willing to take a little bit of risk and actually want to accept this kind of investments that the company is making, you can actually go to their website and see exactly what kind of private firms they are holding and things of that sort. You can definitely analyze the company, especially if you speak French, because their financial statements will be in French. But it's good to know how to kind of analyze this one, how to see through the different prices and ratios here, because when you just take a look at this on face value, you'd be like, okay, this is terrible, I'm avoiding the company. But this is not the way to go with this one. You have to think a little bit deeper and analyze a little bit deeper. That's why you can never really have an automatic tool actually analyzing these things. You definitely have to go through them yourself. So, thanks for watching this one. I hope it was useful. Different thing, different company, different type of company than the usual. And I hope it's going to provide some interesting insights about how to take a little bit of a deeper look at these ones. Thanks again, and I'll see you in the next one, guys. Remember to like and subscribe. Bye-bye.